Sarah, thank you. I think it is justified. I wrote a piece back in mid-January about one of the exogenous risks that had developed was not so much these macro issues, but the fact that sentiment had gotten so stretched, and that set up some vulnerability to the extent there was a negative catalyst. And we saw coronavirus at its outset cause about a 3.5% drop in the market. But then, of course, we rallied back up and optimism kicked back in, and now we're here to go again. I think one of the other issues, too, is that this is more on the supply side in terms of being a shock, less on the demand side, although China does represent a big portion of global demand, which means that the perceived elixir for all that ails us, meaning central bank easing, the Fed's potentially stepping in, doesn't really solve this problem. And the uncertainty with regard to the timing of this and the ultimate impact, whether it's on global growth or U.S. growth or earnings estimates, is still unknown.
That said, Liz, if we did get, say, 2 rate cuts as the market is pricing in, does that help stocks, even if it doesn't necessarily directly help the cause of the shock?
Well, who knows? I mean, that has been the narrative for quite some time, that any provision of liquidity by the Fed, even when it was purchasing Treasury bills to stabilize the repo market, was seen as an elixir for risk assets. I'm not sure how long that persists if the hits to the economy from this are more than just a single quarter phenomenon and or are not seen as eventually being a V-shaped recovery. I think that's the issue here with regard to the complexity of supply chains and the fact that we were already in a situation where companies were having to rejigger things. And just the ripple effect suggests that at least in some segments of the global economy, at best you're going to see a U-shaped recovery, not a V-shaped recovery. And if that starts to really cause a ratcheting down even more of earnings estimates, which have already been under pressure since the beginning of January, with valuations having been stretched, I think that represents a risk of a necessary re-rating.
So how many quarters are you looking at? And what is your new assessment for earnings and for economic growth for 2020?
Well, I don't have any. I'm not a virologist. I don't have any greater color on this than anybody else does. I know we've seen, in terms of overall calendar year 2020 estimates, we've seen them ratcheted down by about 3 to 4 full percentage points, down, now back into the kind of high single-digit range with cuts to every quarter in the year, the majority of which is concentrated in the first quarter. But, I'd have to know the answer to 12 virus-related questions to know whether that's been sufficient. It doesn't seem that it is, but companies are stymied. They don't have any more information than the rest of us to judge on how, make a judgment on how much longer this impact is going to be. All we know is that valuations were a bit stretched coming into this. And now we have this downward pressure on the denominator in the PE equation.
But Liz Ann, even if valuations were a bit stretched, to what extent is the Tina argument, there is no alternative argument to equities, even stronger today than it was yesterday or a week ago, given how rich bonds are at the moment?
Well, I don't know. With the 10-year yield having retested the 2016 lows, obviously yield and price move in the opposite direction. I think yet again, areas like treasuries are proving to be a good diversifier against equity. You see some other asset classes like precious metals doing well. You see a move toward more defensive areas within the stock market relative to some of the high momentum flyers. You're seeing it reflected in factors. So there are ways for investors to adjust portfolio position to become a bit more defensive. And I think that's what you're seeing. I don't think we're witnessing something suggesting that there's literally no alternative to equities. Even within equities, there are alternatives to where the momentum had existed prior to this.
Anastasia, what were you going to say?
Yeah, there's definitely a lot of uncertainty around this, clearly, as Lisanne has pointed out. But one thing that we have been encouraged by is looking to China. And yes, the activity certainly there is still in the doldrums. But the fact that we're starting to see some real-time alternative data indicators start to pick up, like a little bit of a shipping pickup, a little bit of a real estate pickup, does suggest to us that companies are really trying to get back to work. And in China, which is important given the size of the economy, this might actually, the restart in activity may happen sooner rather rather than later. So nobody knows how big of a deal it is outside of the U.S., but the fact that China is starting to come back online, that's quite encouraging. And then to go back to the argument, there's no alternative. I mean, the spread between the free cash flow yield, the dividend yield, the earnings yield, and now at very subdued levels of yields, to me does suggest that there's very little alternative to stocks. And this is why investors are likely to step in and be buying the dips here.
Ann Sonders, thank you for phoning in.
My pleasure. Thank you.